Good morning. It is Monday, January 12th, 2026. If you're holding dollars or treasury bonds this morning, you're feeling a very specific kind of nausea. It's not inflation. It's not recession. It is institutional deconstruction. Last night, we got the report. The Department of Justice is investigating Fed Chair Jerome Powell. The futures market knee-jerked lower. The dollar dropped. The Fed put, that safety net we've relied on for decades, just got dragged into a criminal court. But here's the twist. While Washington is tearing itself apart and Iran is burning with protests, the smart money is doing something completely different. They are finally breaking up the Magnificent Seven. The era of blind faith in big tech is officially over. So, here is the conflict for today. Political fragility versus market selectivity. Washington is chaotic. The Middle East is explosive. But Wall Street is ruthlessly picking winners and losers. This is the pre-market pulse. Let's dismantle the noise. Deep Dive 1. The MUG7 Civil War. Let's start with the lead, because your portfolio likely depends on it. For 3 years, the strategy was brain-dead simple. Buy the MAG7 ETF and go play golf. According to Bloomberg and fresh data this morning, that trade is dead. 2025 was the warning shot, where the group lagged the S&P 500 for the first time since rates started rising. 2026 is the Civil War. We are seeing a violent divergence in the AI trade. The winner, NVDA. Despite the volatility, they're still the preferred play. Why? Because they sell the shovels. The demand for their chips is still outstripping supply. The loser, Microsoft. Investors are turning hostile. They're seeing massive data center capex, but they aren't seeing the profit margins from the AI software yet. The market is saying, show me the money, and Satya Nadella hasn't shown enough of it yet. And then there is the wild card, Tesla. Tesla has effectively decoupled from the tech narrative and moved into the robotics narrative. Its valuation is now entirely based on Optimus and FSD, not cars. The takeaway, if you're holding the Roundhill Magnificent 7 ETF, you're exposing yourself to the losers to get exposure to the winners. Stop being lazy. The data says you need to be a stock picker again. Alphabet, GOOGL, is the consensus favorite for value right now because they are actually monetizing their models. Apple is the safe haven because they didn't overspend on AI capex. The basket trade is over. Pick your fighter. Deep Dive 2. The macro minefield, Iran and Powell. Now, zoom out to the macro nightmare. We have 2 fires burning that could wreck your risk management models. Fire number 1, the Fed investigation. Futures dipped Sunday night because Powell isn't just fighting inflation anymore. He's fighting an indictment. He released a statement saying the investigation is politically motivated because he refused to lower rates fast enough for the president. Why does this matter to your wallet? Volatility. The bond market hates uncertainty. If the Fed chair is ousted or indicted, the credibility of the U.S. Treasury market takes a hit. That is why the dollar DXY is softening. Fire number 2, the Iranian powder keg. Reports from the Wall Street Journal say President Trump is weighing military options as protests in Iran deepen. Over 200 dead. Internet blackouts. The regime is cornered. Normally, this sends oil, USO, to $100. But look at the chart. WTI crude is barely moving. Why? Because the market is pricing in a supply glut from elsewhere. We have the U.S. taking over Venezuela's oil infrastructure. We have a slowdown in China. The market is betting that even if Iran goes offline, there is enough oil floating around to cover it. The trade. Be very careful shorting energy here. If a single missile hits a tanker in the Strait of Hormuz, the supply glut narrative vanishes in 10 seconds. However, the smarter trade might be defense, IDA. Tensions are escalating, and defense contractors get paid regardless of whether the oil flows or not. The silent mover, Dr. Copper and the data center boom. While everyone is watching the political circus, a massive commodity move is happening in the shadows. Copper prices are moving toward record highs this morning. The media will tell you it's because of China optimism and stimulus. That's only half the story. The real story is the data center boom. You can't have AI without electricity, and you can't have electricity without copper. Demand from data centers is colliding with the EV infrastructure rollout. Analysts at ING and UBS are forecasting shortages through 2026 because mine production is flat. But here's the trap: Greenland. President Trump is making noise about buying Greenland for its rare earths. MP Materials, MP, and other rare earth stocks are popping on the news. Experts are warning that Greenland has zero infrastructure. No roads, no power. It would take a decade to get a mine running there. This is a headline trade, not a fundamental one. The signal: stick to the metal that is already being mined and is already in deficit. Copper, COPX. This is the physical AI trade. If you own NVIDIA, you should own the wires that make NVIDIA work. Let's translate the headlines into money. 3 tickers. Rapid fire. Ticker 1. MU Micron. Verdict: bullish. Why? The Wall Street Journal report this morning confirms it. AI is driving a memory boom, but chip makers are refusing to rush capacity expansion. That means higher prices for longer. They learned their lesson from the last bust. Supply discipline is equal to profit margins. So, buy it. Ticker 2, WBD, Warner Brothers Discovery. Verdict: bearish. Why? Today is the 25th anniversary of the AOL-Time Warner merger, the worst merger in history. WBD is the remnant of that disaster. They are still drowning in debt, and while the Paramount rumors are swirling, legacy media is a melting ice cube. Do not buy the nostalgia. Sell the debt. Ticker 3, PNC Financial. Verdict: bullish. Why? Quant ratings are flashing bright green. While the big boys like JP Morgan and Goldman fight over Apple cards and regulation, regional banks like PNC and First Horizon, FHN, are scoring highest on profitability and momentum heading into earnings this week. This is the quiet quality trade. Here is your playbook for the next 24 hours. 1. Watch the yields. The Powell investigation is a major risk to the Treasury market. If 10-year yields spike, tech will sell off. Watch TLT closely. 2. The earnings rotation. Earnings season kicks off with the banks. Keep an eye on JP Morgan tomorrow morning. If they guide lower on consumer credit, the soft landing narrative is in trouble. 3. Respect the copper. Copper at records is a global growth signal that contradicts the recession fears. Trust the metal, not the politicians. This was the pre-market pulse. The news is chaotic, but the charts don't lie. Trade safe. If you like our content, remember to hit that subscribe button.